Hi, this is Randy Finney with the right side of the chart, and this is a closing market wrap for Friday, February 28th, 2020. So now we've closed the month, and we'll take a look at the charts and a couple of things that stand out to me. I'm going to do this video. We'll keep this one to subscribers only, gold and silver members. I may put another one out with general market commentary. But we now have, since we have another official trade on QQQ, I pretty much go dark now on that trade. That's or I'm sorry, not public. It's private content, subscriber content. I'll continue to update that trade. Like them all, it'll either work out or not. But I feel really good about this one. Like I told you yesterday, I'll take these shots all day long. Come in on a drop. The way I see this, I know a lot of people out there are freaking out about coronavirus. And look, I said this in the trading room today. One thing I can tell you is the news ebbs and flows. The headlines will ebb and flow, bullish, bearish. If there is even a slight abatement in the fears and or your progress of what's going on with the coronavirus, I'll be honest with you guys. I've been so busy I don't really track it. I know it's a serious thing, but I don't dive into the news. And remember that the companies that publish the news, they sell headlines. They need to have sensational articles. So I'm not saying there's a conspiracy out there, but just keep that in mind that they're going to spin things one way or another. What it comes down to is many factors. It's public sentiment, what the public thinks, how concerned they are. Is it, obviously it's caused some selling in the market. There's no doubt about that. And then selling begets more selling. But again, I've said this, and I said it quite often here as we were going up, and I kept looking for these little 60-minute trendline breaks. We're on a daily chart here, but I said, mark my words, sentiment will change, can and does change on a dime. In other words, you go from a bullish, bulletproof market where everyone thinks there's no sign of a recession or a correction in sight, and then boom, how long did it take to go from that with the market peaking right here, February 19th, today's the 28th, 1, 2, 3, 4, 5, 6, 7 trading sessions ago. And so there's an example. Now, where I'm going with this, it can go the other way. So can we go lower? Yes. Do I think we go lower? I don't think so. Otherwise, I wouldn't have added the long today. And so, we took a shot yesterday on QQQ, was stopped out for a minor, 1.6% loss. We're already up a little more than that. Now, I'm not getting excited on that, but from where we entered that trade, excuse me, was about 203 and 55, I think, when I screenshot it, tried to get out to you guys as always as quick as possible. And so that was somewhere in here, right about there. And it's profitable by about a little over 2%. This is showing after hours right here. So let me show you what I'm looking at. Yeah, revised. Here's another downtrend line right there. QQQ broke out. And just like I was saying for many, many months, one of these little 60-minute chart, little divergent highs, those seemingly innocuous divergent highs on those 60-minute charts would then have a domino effect where it triggers a breakdown that then goes down, maybe plays out for what that 60-minute chart is indicating. In other words, I'll tell you what I'm talking about. We go over here to a 60-minute chart. Here's a divergent high. And so what I talked about is, I had near-term targets, and I said the potential there is that one of these little 60-minute divergent highs and these little 2, 3, 4% corrections has a potential to then go on and take out more significant trend lines. These little corrections here after these divergent highs were small, and they took us down to support levels within an uptrend. But this one, what it did different, is it took out that October trend line off the October 33rd lows. So that was then the catalyst to open the door to a much deeper correction. So I'll tell you that it went farther than I thought it would, at least farther and faster than I thought it would from here. I'm not going to tell you I saw it going this far, this fast. But again, I warned her that. Now, what I'm doing now is warning in reverse that when you come down here, you hit these levels. We hit a couple support levels that quote unquote should have held, where the buyer should have stepped in. And it's not as if they didn't have reactions. They had reactions there. We had a reaction, we had a bounce. But then when those support levels gave way, they opened the door to the next move down. And so where I'm gonna kind of wrap this up on this daily chart here is that one of the reasons I added it is that 200-day, like I said, to me is a big level that and I've harped on a lot lately, so I'm not going to beat a dead horse, but it's a big level where traders, and not just humans, the algos step in and buy. And what happened today was taken out. So you might say, oh, well, Randy, that's bearish. No, actually, that's almost to be expected. You would almost put money that when you have a near vertical drop heading into a support level. And again, this may not hold. Maybe next week we smash, keep going. I really doubt it, but it's possible. But when you're coming down on a near vertical plunge, you get that what I call momentum fueled overshoot. It's almost to be expected. And the fact we recovered it, that we broke the 200 and recovered it, and we also kissed now what looks like a pretty valid trend line here. You can see on QQQ. We have a reaction here. So now this is a valid trend line. The reaction is we hit that at the lows today, and that trend line lines up perfectly with this reaction low here from early October and this reaction low here from June 3rd, I believe it is. Yep, June 3rd. So now we've bounced. Now we need to see another candle up here. So where I'll leave it is, bullish because we, successfully defended this 200-ish support level. It's a line I added here. You can see the reactions. We may still dip down, and I tell you, although I favor a bounce next week, and if it happens, it could be explosive. It could happen at the open. We could gap up 1,000 Dow points on Monday, and it would not surprise me in the least. Not at all. But if we go down, there is a possibility if the futures tank on Sunday night, this right here, about 193.68, is even better support, price support than this 219. Here you had the 200-day, and again, sometimes you undercut it one day here, second day, so you could still undercut it and regain it next week. And again, there's no guarantees we have to regain it, but this was a key level here. The market had tried several times to get above that 193-ish level, finally broke out here. So you have more reactions back here. It was a more significant level, and now what that'll do, and this is why I do these videos, try to convey my thoughts. It's up to each of you where to use a stop. I used a tight stop today, just like yesterday, because I wanted to come in on a level where I thought we'd bounce. And if wrong, if we took another leg down, then nothing ventured, nothing gained. Small stop, get out. However, you may want to widen your stops. I'll tell you, personally, I'll give it a little room to down here. Now, where we bounce back to today, that would be a pretty big drop there. But from the lows today, it's not that much. You're only talking about another 2.3%. So if the futures are down 2, 3, they could be down 4% on Sunday night. But if you start to see them recover and we open up or around this level, look for this level to hold on Monday. And if you didn't step in yet because either you don't like catching falling knives, or whatever reason, or you didn't want to, I get it. A lot of people don't want to go home. They're scared of what might happen over the weekend. I'd be more scared right now being short going into the weekend than long. So, so I'm long now. I'd be more scared about being caught in a 3 to 4% gap up on Monday against my position than I am a 3 to 4% drop. Just look at it this way. Again, QQQ has dropped from high to low in just over a week, 16%. I think a lot of the worst case scenario in the coronavirus is probably priced into this market. And again, it's more so about are the liquidations, the forced selling, is that over? So there's your levels, guys. Keep it very simple. From today's lows, 193.68, give or take, comes in about a little over 2% below. Targets, I already laid those out. Bounce targets there. First target's 210.75. Second target is 214.58. The lines on those, just I set them a little below. 210.88 is that resistance line. It's not a hard line. It's a rough level. And then that one's at 214.84. And I am very open and may add an additional target. In fact, let me do this for you now. So when I update this trade on Monday, I'm going to say potential T3. Let me turn the caps back off. And that is a potential bounce target that I believe has a good chance of being hit in the coming days to weeks. If these targets are going to be hit, here's the thing. we'll probably either have that stop hit on the trade. I should color that line. That's the stop line right there, 219. We'll either have the stop hit on Monday morning, we gap down or go down, open and then drop, or this trade's going to play out. So my money is on we're either going to be stopped out Monday morning or at least hit this trade on Monday. So if you're, wondering, for you options traders, sometimes I get asked a lot. I'm not a big options fan, but I can tell you I'd buy near money because, this trade, with this kind of volatility, you're probably not going to grind around sideways for a while. It is possible, but there's 2.5% upside from where we closed today, and another 4.3%, and that's again on top of about the 2% that we've gained since that trade already. And then if we get up all the way up to there, that potential third target there around 224.45, that's the bottom of the big gap. You're talking about another 9% again from where we're at right now, not where we entered the trade earlier today. Everything else I already mentioned in the update. Extreme. We could become more overbought. I always caution that overbought is not a buy signal, but it's where you want to start, especially in a bull market. Like I spent a lot of time today in that trend video. That hey, as ugly as this correction is right now, it is nothing more at this point than a correction within a bull market. So you have to treat it as such and say, well, what happened? The last half dozen or more times that the RSI hit or crossed below that 30 level, would you want to be long or short? Even this little one there, you say, okay, well, we hit it there. That was a little early. Well, no, from there we bounced, measured out here with the measuring tool, 4.5%. Then we took another leg down, and that's possible. And it was a pretty powerful leg down. You might not wanted to ride that one down, but from there you had one of the best buying ops, over the last year or so. So that's it. I'm just circling these levels where the RSI. And we may not even hit the 30 level there. I don't want to try to split hairs. RSI looks like it hit a low of 3140. So technically we never even hit the oversold level there. So this is the one right here. There, right there, and right, we hit it. Looks like just hit it there and just hit it there. So again, that's wash, rinse, repeat kind of stuff. And oversold to support with the dual support levels, 200-day EMA and the 219. I had it as a price level, but it's also the stop there. That's it. Not much more to say about that. I'll either be right or wrong on this one, and if I didn't think, the risk reward wasn't there. Again, that's everything that I do factors in, a relatively small stop for a potential trade that could be, up to 10% or more. So that is a phenomenal risk reward ratio. What I have to say is that where that trade can somewhat backfire is if we had a huge gap down that bypasses a stop, because a stop on QQQ, any standing limit stop loss orders get filled at the open. So that's where it can kind of skew your risk reward ratio. There are no guarantees. If we get gap down and you get stopped out at, let's say, 4% on Monday instead of at the 219 level. But again, it's all math, probability, statistics, and of course the technicals, looking at objective levels. It's not, I don't use pure statistics, just saying, oh, the market's down, so it's going to bounce. That's kind of crap shooting. I line up the oversold conditions. Look at the huge selling, the huge bar right there on the volume. I don't know if you can see it. That's a potential near-term selling climax. And then just to kind of reiterate what I said the other day, I'm just near-term bullish. I'm just looking for a bounce here, and there was a lot of technical damage done. I will kind of reassess if and when we get there, and then decide, is it worth it to trail stops, leave stops in place, not take profits, and try to shoot for maybe a back test of this trend line, or even a run to new highs. Because I'll tell you this right now, the trend line, we're so far below it, and it has such a steep ascent that any back test of it is probably going to bring into play new highs or very close to it. You can see, let's say it looks something like this. The longer it takes to get there, assuming we ever back test it. I mean, we may never. That's possible. But Assuming that we do, you can see it's not too far off the highs. And to back test it, depending if and when we got there, we'd also be taking out this gap. So if that top of the bottom of the gap is certainly resistance, as is the top of the gap right here. I'm talking about this gap down from January 20th. I'm sorry, January 21st over the weekend. That was open on Monday. Gap down on the 24th right there. Other things I like, and I'm just trying to keep my focus narrow. I'm sure there's quite a few questions out there, and when the markets are moving the charts are extremely dynamic. I always say that the charts are dynamic, and so is my analysis, meaning the charts change minute by minute. When a fast-moving market, they change often. So I'm kind of hyper-focused. I'm looking for obviously focus on the markets. There's going to be individual stocks that will explode off the lows once this bottom's in, and there's going to be some great short setups, and we'll look at that too. And we get a bounce, I'll be looking throw out some more short ideas, like I had put recently when we were topping before. So what I wanted to get at is there's not enough time in the day for me to analyze each and every FANG stock, all the components of the NASDAQ 100. When volatility is like this, and you have the potential, we just dropped whatever it was I said, what is that, 17%? I must have missed that high on QQQ. 16% or whatever, and now I see the potential for maybe a 10% bounce, maybe even more, maybe 12% if that to get to that gap. It's a little easier to focus on QQQ because when the money flows shift, when they finally flip that switch, I thought they might have flipped it yesterday, they didn't. When the algos change from sell, sell, sell to buy, 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 and those orders start firing off, it's pretty darn easy to be in QQQ instead of laying your bets on just one or two stocks. I laid out Apple, and like I said, Apple, I'll give you some targets on that. I made a case in that post today. Apple, both at price support 255.74 and the 200-day. Longer term, probably more downside, but not guaranteed. We had a divergent high here. I just want to point this out that, you don't, sometimes you get these one and done corrections. That was pretty much, it was a little consolidation in their little ABC corrective wave. There was a one and done. And this one, well, there's your little counter trend rally in between. But it's possible that's it, but we'll probably, with such big bearish candles on the weekly and even monthly charts now, we'll probably get a kickback rally. And like I said, a lot of potential on Apple. So I threw that out there because you probably have more, well, you would have more bang for your buck. And that's almost always the case when you trade individual stocks over an index, because when you buy an index, whether you're going long or short, think of it this way. If you go long the NASDAQ 100, you are buying the most bullish stocks that are going to have the highest returns during the time you hold them, and you're also going to buy the most bearish stocks within the most bearish sectors that dilute down the returns. You might say, well, why would I do that? Well, the benefit is diversity. Let's just say I banked everything on Apple, and because I see if we come even to test the bottom of that gap right there, you're talking 17%. But let's just say this is the one of the FANG stocks, one of the big components of the NASDAQ 100 that happens to either not go up or underperform on the rally. I don't think that's going to be the case. That's why I highlighted it here. I think they're going to step in hard when the switch gets flipped. And on the flip side, if you want to know where the additional downside levels are, you can see them here on my chart. I'll turn the lines up a little bit. 200 goes with conviction, then there's not a lot of support down here at about 233.09. Apple's already exceeded this. This was a target that I had for many weeks. We can go back here and I'll find it for you. Here's one. I have several charts on Apple. I just went back to this one. You can see on the screenshot, timestamp below, January 8th. So on January 8th, a month ago, I was calling for a drop. And again, said we didn't have a sell signal at the time. We're inside a price channel, but calling for, at that point in time, a 10% drop. Now, we went up more from there. So Apple was at 298, and I had us going down here to 267.70 plus this trend line. And that's a 60-minute chart. So where are we at? There's the trend line. It was hit and then some. And so just to get to that trend line from where we peaked, following earnings, and again, we had the divergent high and everything else. It's not letting me do this. Move that up there, grab about that point, And so that was good for, well, we hit it right there. About there it is, yeah, right about a 10% or so drop from there. So I guess it didn't go too much higher. There, oh, there's a channel, by the way. That's that same price channel right here. I had it on a different board. There's the line. So there was our sell signal breakdown, back test, and never went higher. Kept, stayed pretty much. That's why I have that line. Put a divergent high there. The divergence was intact because it only made an equal high as the indicators kept making lower highs. So we hit that target and then some. But now, again, you can see it's at support. So there's a pick for you if you're looking, you've been wanting to buy Apple for a long time. Even again, just from looking at these, it's just bounce trades now, but I'm fully open to the possibility that this whole coronavirus thing can kind of blow over and then the market can go to new highs. The economy is still on pretty solid footing right now. This correction in the stock market is going to put a damper in that because it knocks down consumer sentiment. That's, like I said, sentiment can change on a dime. So you're going to see that when the surveys come in, the sentiment surveys, and then that people reel in their spending a little bit. But the more the market snaps back, the more sentiment will rebound, and that's that. So again, everything's dynamic. We'll assess it as it goes. If we even get a bounce, if we keep melting down next week, if we melt down more, it means the market's just broken. And who knows? Maybe I keep talking about how the news flows could swing a little bit better over the weekend with coronavirus, but who knows? Maybe a big hedge fund blew up. I have to imagine with this quick drop, when you get these drops that seemingly come out of nowhere, it catches a lot of investors off guard, and you have hedge funds that are leveraged to the hilt in stocks like Apple and Microsoft and all those. And if they didn't have proper risk management, especially with that leverage, they can be wiped out. So you hear these funds blow up, and sometimes they have ripple effects in the economy, usually not. But again, I'm just telling you things that could pop up here. And so what I'm trying to say is we're not out of the woods. When you have a drop like this, it increases the chance that things could break. There could be something major. I'm not even going to say we're not even to the point where I'm really that concerned about bank failures or anything like that. But just want to say it's not good if you continue to go lower. So let's leave it there. I don't want to beat a dead horse anymore. I like Apple. I like QQQ going into the weekend, and I think, like I said, I think the risk is to a big upside gap on Monday, more so than to the downside based on where we're at. Oil, really like oil. It's been a busy week. I had a lot of things on my calendar today. I told you I had to step away today. I've got a lot of stuff going on. But I came back and I was considering adding this one, but look, we put QQQ back. USO, I still think this is one of my favorite commodities right now, because reason number one, it tends to trade with the stock market with economic expectations, and number two, I mean, you just gotta love this chart. I don't know, we all see things different, but okay, back here we had a major bottom in USO, and I pointed out these divergences back then. This is what I like to see, and you don't get it often. When you do, I don't like to ignore them because that's when the big opportunities come. This is positive divergence, very clean and clear positive divergence. Oil was in a meltdown right into the December 24th lows back in 2018 when the same exact day, it's not coincidence, the market and oil bottomed right at the same time. I believe it was on the same day, on the 24th of December. And you can see from there you had one of the biggest rallies in crude oil in years. I pointed it out here. We took a shot here. We got that one, got out. And then we took a shot the other day. Where was it? Here again. Had a really tight stop, got out, and now again, I think this is a very objective level. And yeah, hold on one second? Let me check some. Okay, I was just looking at the sites, I think, because I had considered adding it today as an official trade, and I don't think I did. I just want to make sure I didn't do that and forget about it, because again, what I trade, what's official, it's kind of blurred. Sometimes I'll take it. I'm obviously going home long into the weekend. This is, to me, a very objective place to be long. Big potential divergence. Now, potential means I would say that the PPO and the RSI are still pointing lower. They're momentum indicators, and I pointed out several potential divergences in QQQ late, and they were burned through on the index as well. Not several, one since this thing started, and they did burn through the 60-minute divergences, at least on the PPO. However, that's it. All I can say is that's when you have a major reaction low like that, it usually acts as support, at least on the initial tag. So even just a bounce in crude, if it happens to bounce all the way up here, and I think with that divergence, it's possible. So where we go from here, either this is a just a nice correction and a bull that has more room to run. I'm talking about the equity market, and if so, I would be very, very surprised not to see this play out for a rally back up to that level in crude oil. That's about a 14 or so percent rally from where we bottomed today, and so I don't really can't add much more to that. As far as targets go, did I share? Yes, I did. I shared this on the site in the trading room, I believe, today. That's right. That's what I did. Let me find that for you guys. Okay, come in the trading room. If you click on anybody's gravatar, that's this little image thing here. Click on mine. That's the easiest way to sort by it. So yeah, it's all the stuff I posted here. Where did I put it? Would have been in the swing trading group. Yep, here it is. Crude CL crude futures likely to spark a short covering rally on a solid break above this price channel. Swing target. Well, I'll show you the chart here. Here's the price channel. These are the futures, crude futures. This here. Let me get to the updated chart. That's the one I posted earlier. So we're closed right on it. We're looking at a 60-minute chart of CL, and I'll give you the levels on USO as well. There's a price channel right there. We had one here, never really broke out. I even highlighted that one, but we didn't break out of that channel. We dropped into a steeper channel, but it's a very tight, steep channel. Divergence on the RSI right here, and this is that comparable level right here. There's that support shelf that gave way, so it's about 49.63. And on that post, I also gave you. Let me move this down here and give you. Go back to the trading room, and nope, that's it right here. I'm going to find it sooner or later. There it is. USO comparable targets right there, about 1040. Let's just go to the live chart of USO. Markets are closed, but here I can turn on. I think the after-hour trades are on. Showing here pre-post data outside of normal hours. There we go. What do I see in this chart? Again, I put a little higher weighting on crude futures than USO, but USO does a very good job of tracking. It's a fine vehicle to trade if you don't trade futures. And if the CL is a little too big for your taste, you like futures, but it's a little because crude's a volatile sucker. It can move up and down a lot in a day. QM, I believe, is the symbol for the micro crude futures. It's going to trade the same exact levels as CL that I just showed you, just uses a smaller leverage factor. So then you have that ability to kind of manage your position around the clock. 3 in the morning, if you want to exit the trade or get into it, you can buy QM or CL. But on USO, you're going to have to wait till the regular session or pre or post market trading session. So there's a comparable downtrend line, but really what I want to show you here, the positive divergence, PPO is starting to curl up at very low levels. It did make a slight bullish crossover, but that'll to be continued or not on Monday. We'll see. And if so, there's a couple gaps to target, but I think we'd come in back to that 1040 level, and if so, that would give you a pop of about 9, almost 10%, of course, in USO as well. So there's some trade ideas for you next week. The other things I went over in the charts I'm watching today was gold. Fortunately, with gold, I think we called that one pretty well. Had a breakout right here. That was the level I was watching. Broke out. Was bullish and long most of that run. But up here, I said, look, it had gone parabolic, and break of that trend line would do the trick, bring us back. I gave a couple targets, and it fell. Now, here's what I'm getting at. This gold. Oh, well, I'd actually already hit my target. That was, this morning. Here, let me find that chart, that post. Okay, this was one this morning. Again, you probably already saw that. And so what happened is, what I know, we got the breakdown, and so I know a lot of you quite a few people said they exited or even shorted gold, silver, and we got the pullback. And so what kind of stood out to me today is, and recently, treasuries have been rallying with this sell-off, but gold isn't. And I always say treasuries are the king of risk-off assets, gold being a close second, meaning they risk-off assets, I'm sorry. They rally when the stock market goes down usually. But what we're seeing is the market has been falling and gold didn't. Now, part of that, it was technically based for the same reasons I cited back here. But the other thing is to see gold not rallying during the meltdown. Now, if you think the market's going to bounce soon or is getting close to a big bounce like I do, then yeah, that it doesn't bode well for gold. And so gold already did. That was again this morning's chart there, 1640, and I had the next target below it, 1580. Here's a trend line that comes in, and it did. So gold fell, and that's what I'm getting at too, guys. Is that's telling me that smart money, institutional investors, whatever, they they're probably positioning for a rally or expecting a rally because they're selling their gold now. They don't want to wait till the Dow's up 1,000 points next week. Looks like they're getting out now out of gold, and we'll take a look at treasuries too. So that was this morning's chart, and there it is. Boom. So from there, 1600. And then we sliced on through there, and look, there's that trend line I had here. I'm going to extend that out, and that's probably going to come in right around where we held. So now at this point, I certainly wouldn't short gold, even if the market, even they'll expect a bounce of the market. It's corrected quite a bit. It's still in, and I haven't waffled on this at all for years. And gold's in a bull market, primary bull market, so there are going to be corrections along the way, and I think that's what we just had. So I'm going to tell you this: I'm near-term neutral on gold. If the market rallies next week, can gold rally? Absolutely could, but usually it's going to come off and come into some selling pressure. So we could break this level, but again, I'm just going to leave it there. I'm going to watch, wait for the next objective long or short entry. But part of what this was, I think what happened here is gold had been strong and had been rallying along with the stock market up to the recent highs, and so I think this was a lot of that margin call forced selling, and I think that was probably a washout today. So near term, I don't see any reason to step into gold. Long term, not a bad time to buy if you're looking to add to your portfolio. I've been a big proponent of having gold as part of a long-term portfolio asset allocation. Your long-term money, and if you liked it up here recently, you got to love it down here. It's 7, almost 8% cheaper than it was just recently. So just wanted to touch on that, and I'll keep an eye, but you're probably not going to see as many updates on it until I see something actionable. I'd just rather stand aside next week, let the dust settle on gold. Let's look at treasury bonds. I told you they're likely to pull back soon too, especially if the market rallies. No sell signal yet. I've been highlighted right here. Here's a little trend line we have, a little wedge type pattern, negative divergence on the RSI up above, no divergence on the PPO, but we're pretty overbought. And again, this is the king of risk on assets. So they rallied, and I'm surprised that we didn't see a sell-off into the close. But I think there's a short trade to be made next week, especially if the market rallies. But I can tell you it's going to be a highly correlated trade. You can either be long equities or short treasury bonds or both. But if you are both, if you're long equities and short treasury bonds, you're either going to be right on both trades, most likely, or wrong on both, most likely. Again, no guarantees. Pullback targets now, we're looking at, if you're a ZW trader or ZB, about 3% drop to my first target, and I think we'd go through there after a reaction, come down here, at least to this trend line, possibly down here, and that would be from where we're at right now. If this one's hit, that's about a 4.5% or so, something like that. And of course, I know I cover these all the time on futures. It just kind of gives me a better picture because ZB is trading around the clock. But TLT is your ETF that trades a 30-year bond. I don't have this chart marked up right now very well. It's kind of gone parabolic like gold did. The reason I pointed gold out is likely to have a correction a week ago because it had a little parabolic run like this. So I think there's quite a bit of hot air. Minimum target, swing target, if you want to swing it down, about 6%. And if you don't like shorting, but you want to play a pullback in treasuries, buy TBT. It is the 2-time short. Leveraged short treasury bonds. So you're going to have TLT times 2, whatever it does. And I'd give you the old levels there. These were old targets. Don't disregard those. There's your target right there, unadjusted target. That's the actual resistance. Sell a little bit below that, 22.76. That'd give you about a 14% gain right there in TBT. So remember, 2-time leverage, but here's the thing. Normally I'd say, okay, it's 2-time leverage, so factor your position down. If it was a 2-time leverage, let's say QID, which is 2 times a QQQ. I would say, okay, instead of taking $20,000 position in QQQ, take a $10,000 position in QID because you have the 200% leverage. But that doesn't really hold true to me for treasuries because treasury bonds are much less volatile. They don't go up and down as much during a trend. So when I'm trading the treasury, if I'm not trading ZB, the futures, if I want to use this, let's say in an IRA, and I want to short treasuries, I'll buy a full position in TBT because if it goes against me, it's not going to drop as much. So I just want to say, in other words, the way to say it is I'll beta adjust TLT when I'm trading it by 2 times. I'll take a 1.5 to 2 times double position than I would on, let's say, QQQ or SPY because it doesn't go up and down as much. And likewise, so if I do TBT, I can take a full position in it. So there's an idea that, and again, chances are there are no guarantees. Sometimes these things that are inversely correlated have periods where that inverse correlation disconnects for a while. So I can't tell you definitively that if the stock market rallies that treasuries are going to, but I would put a very, very high degree of confidence on it. And again, that would be a swing target right there, about 15%. So maybe I'll add this next week. I have a suspicion that the market's going to gap up pretty big next week on Monday. And if I miss objective entries on some of these, then I miss them, and at least for official trades. Putting it out there. I'm doing the video now. It's a little before 5. There's still time to buy this. If you're, somewhat of a gambler, risk investing, trading takes some degree of risk. I wouldn't go home heavy long or heavy short over the weekend. But like I said, a little bit of long exposure here on the markets, which would be a little bit of short exposure. You could buy TBT and after-hours session trading, and maybe a partial position. If it starts to pan out on Monday, add to it. Even if it goes down, this chart, you're still going to have the bullish divergence, and treasuries are getting really lofty. Remember, treasuries, unlike the stock market, there's more of a floor in treasury bonds. The stock market, there is no ceiling, and there is no floor. Well, the floor would be 0 technically, but what I'm trying to show you here, I'm jumping all over the place. These are treasury bond yields, TYX. This is looking at TLT in reverse. These are the yields on the 30-year treasury bond. The floor is going to be 0. This is the interest rate they pay. We've been in a cyclical bear market in treasury bond yields, so which means a cyclical bull market or secular bull market in TLT, treasury bond prices, which inverse to yields. So I just wanted to say, what I'm getting at is you get that what I call price compression. The closer you get to 0 on yields, and we're not there yet, I know we can have negative yields, but we're not going to have negative yields anytime soon on the 30-year treasury bond, maybe short-term stuff. But what I'm getting at, you get close to that, and incrementally your yields aren't going to drop that much. So, like I said, that's my view on treasury bonds. All right, guys, it's a long video. Maybe I should wrap it up here and get out to you. So those are some of the main asset classes I'm looking at. Like I said, we could certainly continue down next week. Markets could crash. Anything's possible, so don't go crazy on your positioning, especially over a weekend where you're going to have the market's going to gap up or down. That's about the one guarantee. We're probably going to gap up or down big on Monday, and so you're either going to be very happy or very unhappy if you go home aggressively positioned. But I'm leaning towards a bounce. If it doesn't come right away Monday, we'll probably bottom out sometime next week and have a very sharp oversold rally, short covering rally. So near term, I'm looking bullish equity markets, bearish on treasury bonds, neutral on gold, and bullish on oil. That's sort of in 10 seconds to cover what I just covered in over 30 minutes in this video. All right, guys, I'm going to wrap it up here. You guys have a great weekend, and if I see anything that stands out over the weekend, I'll try to get out to you. Otherwise, we'll pick this up on Monday.